All right, boys, let's talk about thinking in probabilities and statistics. Okay? This is probably one of the most important skills you could learn to do as a trader because trading is officially gambling. The definition of trading is betting money or staking money on an uncertain outcome. Okay? Trading, there's never a certain outcome. Ever. You never know what's going to happen. Whether it's going to be a news drop, whether it's going to be one guy in the world just selling billions of dollars, a hedge fund selling billions of dollars for no reason because maybe they got some insider info, whatever. It's just unpredictable, right? It's essentially gambling. But by thinking in statistics and probabilities, we are able to make it in our favor in a sort of way, right? We could basically place a bet on higher odds. It's nothing like a slot machine. It's nothing like, roulette or anything like that. It is still gambling, but if you have the statistical edge, then you have a greater chance of making money, right? Because that's all we can do as traders. We have to follow the footprints, follow the steps of the people with billions, hundreds of millions of dollars because we just don't have enough money to actually move the markets ourselves. So we have to follow them, okay? Now, one great way to think in probabilities is by looking at the market sentiment, right? So right now, the past let's look at the daily. The past since July to September. So like the past like 2 months, we've been in a bear market somewhat with about two weeks of bullishness, right? That's what we're seeing. Now, what are the odds that the market comes back down here to continue the bull market or the bear market? I don't know. It's maybe 50-50, right? Just by looking at this chart, I don't know. Is it going to stop right here and go right back up? We don't know, right? So we need to do something to give us that statistical advantage, right? So, for example, the trend lines, like we have in other videos about trading the trends. That gives us a statistical advantage because as long as this trend line holds, we could assume that it's going to keep going down. But if the trend line breaks like it did right here, who knows? Maybe it's going to go up. So right now, we don't know what's going to happen because it broke the trend line, right? We had that massive bullish day yesterday. Today, we are dumping off a cliff, but we're still outside the trend. So we don't have a statistical advantage. We basically just have, you know, nothing from the daily. So we're going to look at the 15-minute chart. What do we see here? Whole lot of chop. When we were in the zone, we were trading, we basically had no advantage. All we had was the range, right? So if we go down to the 1 minute, we have this range. We saw this top, we saw this dump, we saw it pump back up, dump again, oh, overshot, dump again. Okay, so now we have somewhat of an advantage because we see that it's been ranging and that it's still ranging, right? Now ignore this massive dump off, but just think about it. We have this range. So now we have somewhat of a statistical advantage. Whether we short, near the top of this range, right? Because we think it's just going to go short just because that's just what we think, or because we looked at the daily and we made a bias that we look like we're in a bear market. Whatever the reason you have your belief that it's going to go in a certain direction, Hopefully it's provided by some kind of, technical analysis or something like that. But regardless, even if you don't know which way it's going to go, if you short the top or a double top, then you have a statistical advantage because stocks like to range way more often than they like to break out. So just by entering towards the high of day in a short position, you have the odds in your favor that it's going to reject. Maybe it'll reject just a little bit and come right back up, but there is an advantage here because there will be liquidity sitting around the high of day pretty much always, or the low of day. There will pretty much always be liquidity sitting there just because that's how traders trade. They put their stops above highs or close to highs, and then breakout traders, buy after a breakout of a high, which is not recommended because you lose your statistical advantage if you trade a breakout, because the market tends to range, right? So just this one simple thing, depending on the day, depending on the markets, like if we see it just breaking highs consistently, like every single time, making new highs, you know, you might want to change the probability. But something like here, once again, had a high, diddled around, came to retest it. That's another double top. Double tops give you a statistical advantage because just purely based on market psychology, people will take profit at the top of a range rather than buy into it and risk all the downside. So just taking a short at the top of a range or taking a long at the bottom of a range or a double bottom, triple bottom, whatever it is, statistically, if you caught the very, very bottom, you could put your stop loss, I don't know how big you want to do it, that's up to you. But based on pure probabilities, the likelihood of it breaking out is much less than it ranging, right? Because there's going to be resting orders there. People will be taking profit, closing their positions because they don't know if it's going to break out. So just thinking like that, thinking based on probabilities, based on where liquidity is, or pivot points, refer to the other videos on how to increase your statistical chances of having a winning trade, or increasing the probabilities of having a winning trade. Simply just go with the trend, or play the tops and the bottoms of ranges. Don't just enter in the middle of this, because chances are your stop will be too small and you'll get stopped out without it making a major move. Make sure you realize how the market is by looking at the bigger time frames. You know what I mean? Like today there's not too much. But over here, we see a clear cliff happening. If you were looking at this candle, you might be like, "Oh man, I don't know." But you could see that it is holding a direction. So betting on it continuing that direction has a higher probability than you just randomly betting on it this being the bottom. Like, oh shit, this is the bottom because it's turning into a doji candle. I think it's gonna go up 100 points. It's the probability just is not in your favor by betting on a reversal. It just really isn't. Now, if we had something like a pivot point plotted, right? Like you learned about in the other videos, like last week's low that was held 1, 2, 3, 4, 5, 6, 7, 8. This is a major level. Now, if you see a cliff dive coming into this level, then that partially boosts the probability that you could take the reversal trade off of it, right? You could. But with trends, they tend to be very, very strong. So you would have to have a clear signal that it's reversing before you take the trade. Now, you could blindly take the trade based just on pure probabilities, and it could work. And I mean, if you're doing it off a major pivot point like this, then there's a good chance it'll work. So I probably would take that trade, but I would keep my stop loss tight if I'm betting on the reversal. I'm not gonna let it run 100 points against me or 200 points or completely blow up my accounts. I'm gonna take a tight stop loss on a trade where I'm betting against the trend. Now, if I'm betting with the trend, stocks need breathing room. They do need breathing room before they make the next leg down. Just like right here, we had that giant bearish engulfing. Good sign that the uptrend could be over, right? We had a few of them. And it did lead into a brief downtrend. Then we had a bullish engulfing on the 5 minute. That's a good indication that possibly an uptrend, right? So if you see a bullish engulfing close engulfing, so that means that this single 5 minute candle ate the previous candle and closed higher than it, then there's a good chance, a good probability, maybe 70% that it's going to continue going up at least a little bit. Like right here, it just went up just a little bit more. It's stuff like this. Like, okay, over here, we had this fucking cliff. But it didn't continue, right? So trading off engulfing candles, probably a lower probability trading strategy than one that goes with a trend, or taking a reversal trade off pivot points. That's probably close to with the engulfing candles, right? But now if you see us hit a major pivot point like this zone right here, we've had huge action in here, stopping and starting and bouncing off of it, for a very, very long time. Now, if we see this major zone, plus major rejection wicks, plus a bearish engulfing, then you're adding into the probability of a trend reversal, right? So that boosts the probability that it could be a reversal instead of just having a pivot point, just having a bearish engulfing, just having this, right? If you add up all of the things that are reinforcing your belief that it's going to go lower, then you're gaining the probability of it actually happening, right? Because you have, okay, so let's do the math right here, right? So we'll do bullish, bull, bear. Okay. So let's talk about this. How to identify which trade to take based on the probability, right? If we're looking at this is tough. This is tough to trade. Honestly, you probably wouldn't even want to trade this. But if we did want to trade this, like I knew this was going to break down eventually because we had oil falling off a cliff, first of all. So there was some bearish momentum in the overall markets, right? So not even NASDAQ, but oil fell off a cliff, right? Right when we were in the zone. So I'm sitting there thinking, okay, a short play is probably coming. So we'll add 1 point to bearish because oil fell off a cliff and, it has basically nothing to do with NASDAQ, but it's just overall market sentiment, right? So that's one reason to be bearish. To be bullish, giant bullish engulfing, right? Sure, that's a sign right there. But then we also have giant bearish engulfing, so we add 1 to bearish too. Double top, 1 more to bearish because it rejected and fell off a cliff right here. That's a bearish sign, right? Double bottom here, double bottom, triple bottom. That's bullish because it bounced, right? Tried to climb higher, couldn't do it. Higher lows or lower highs, 1, 2, 3, along with another double top, but still technically lower highs because it didn't make a higher high. Bearish, right? Liquidity sweep before a pump up, bullish. And that's about all I see for this little chop session, right? Now let's erase all of this and talk about, but okay, you guys get the point, right? There were more bearish signs than bullish here that we could find. So statistically, you have a higher probability of it doing a bearish move, which it eventually did after it broke out the range, right? Because while we're sitting in this range right here, we're wondering what the bigger move is going to be, or we're just trading the range. Personally, I don't trade the ranges. Don't think there's that much money in it. I do trade the breakouts, the trends, all that stuff, and that's what's been the most profitable for me. So, based on this range, it had a higher probability of making a bearish move to break out of it, based on market sentiment, like oil falling off a cliff, also based on the daily, which has been in a downward spiral after having a massive bounce. That's all higher time frame stuff on the daily, so you can't really do it with day trading. But if it's a consolidation area like this, then that could play into the market sentiment, right? Where is the major move going to be? What's the higher probability move of the day? Those are like lower statistical probability things because we're day traders, but it should still play a factor into your trading. Now let's clear this out. Completely. And let's talk about what's going to happen next. Now, we don't know what's going to happen next, right? Because it didn't happen. So we're doing this in real time. Not like that, not doing a replay, nothing. If we look at the higher time frame, mega cliff into a pivot point that we've touched many, many times, bounced off of, broken through, broken right above, back into, held right here 2 times after a little sweep, bounced off of it here, retested it here into another fucking moon. So what we're seeing here is we tested a giant pivot point. Chances are we shook out all the longs that we're holding here. There could be a chance that this goes back up, right? So let's just do an up arrow. Let's do an up arrow for bullish. Let's make our list right here. So up or down trend continuation. What do we have here? We have a pivot point, right? Major pivot point that's bounced off many, many times. We're getting a bounce. That's pretty solid. Let's make a downtrend line here. It's holding the downtrend. Still. So that's bearish, right? And that's about all we get from the 1 hour. Let's try the 15. Okay. Still holding the trend. Do trends tend to continue? Yeah. Yeah, they do. So, what has a higher probability? Counter trend trading for this to go all the way back up here, or letting this bounce come up to our trend line and it rejecting back down? What's the higher probability here? It to go down. Maybe it gets up here, maybe it hits this pivot point, maybe it comes all the way back up here, but chances are it's going to go down, especially if it holds this trend line. So what would I do here? Based on statistics, I would take the short right off this trend line, put a stop loss probably, over here, which is on a pivot point, so it wouldn't be that great. But chances are it's going to continue the trend. So this is somewhat a high probability trade that I would probably take. Because, let's go back to our list. We see giant cliff, mega cliff dive, bearish engulfings on the 15 minutes, higher time frame. Higher time frame engulfing adds another point to bearish, because if it was on the 1 minute, not a big deal. If it's on the 5 minute, somewhat of a big deal, but on the 15 minute, that's a pretty big deal, right? It's holding the trend still pretty consistently. We have three things bullish for us. I'm bearish for us. We have one thing bullish, which is the bounce off the pivot point. Still hasn't broken the trend, so we can't add to our bullish belief here. So if we were looking for longs and we didn't get the entry off the pivot point, then we shouldn't be taking longs here, right? We should be leaning more towards the shorts, because the probability of it working out is much better than this actually coming all the way back up here, or this coming all the way up here, right? So for this trade, we have one thing that's bullish, which is the bounce off a major zone. We could add another one because this is a bullish engulfing for the most part. We see a wick on the 15 minute, which is not great, but then the next one ran through it. That's another thing that's bullish. So we're tied here. So what are we going to do? Either we don't take the trade because, probability isn't high enough, or we enter the higher probability trade based on the trend, because we do have a downtrend, which is the fourth point. Because we have a downtrend, because it's only a 2-candle bounce, which is typical for NQ, right? We see the 2-candle bounce into a cliff, just like we saw right here. Start the downtrend, 2-candle bounce, sometimes 3-candle, boom, into a cliff. The higher probability thing here is for it to continue going down. Now, is that going to be just to right here, or is it going to break out? The high probability trade would be to go for somewhere in this zone for a take profit. So we enter here, stop loss, probably around this pivot point, maybe a little bit above it, with a take profit target right there, short term, right? Now, if it rips through here, then we could look for a re-entry. But for a quick little trade, based on, market sentiment today was super choppy, we're not expecting a massive trend. So if we were to take a trade here, it would probably be short, and we would more than likely take profit right here, because that has the higher chance of success than it actually breaking out and having a full-blown trade, or a full-blown trend, right? But something like this, just thinking about the probabilities, like even if the trade didn't work out, like we entered there and it shot up and hit our stop loss, like that sucks. Too bad. You lose sometimes in trading. Trading is gambling. But the probabilities are on our side that something like this will happen. Now it's tapping a pivot point, right? Let's see if it rejects it. It's sweeping the pivot point. Typical. Maybe would have hit our stop loss if we entered a little bit early. That's okay. We would just be stopped out and we'd be looking for a new trade. But let's say we didn't enter, right? We're still debating on what we want to do. It just tapped a major pivot point. It swept it. That's pretty bullish. Momentum is getting pretty strong on the bullish side, right? We got a nasty bounce off a major pivot point. That's also bullish. The trend is not broken yet. And this is what you should be doing actively in real time. This is happening for the bullish side. This is happening for the bearish side, right? You need to have this running through your head so you can decide what to do next. It's somewhat of a bullish day. Somewhat. And today's Tuesday. Yeah, we had a run up. Then we had a cliff dive. It's somewhat of a bullish day. Market sentiment is somewhat bullish after this massive liquidity sweep down to a key level. Now we need to wait a little bit to see what happens next because we're looking at the 15-minute candle. We still have two and a half minutes left on it. So let's look at the 5. Overshoot of the trend. Still has not completely broken this pivot into this zone, right? So this is a major level, major zone, major consolidation zone, but it still has not broken into where it consolidated earlier. It looks like it's rejecting off this pivot. Bearish. Now we sit here and we wait. I would more than likely be taking a trade here for the short side because this was such a fast impulse move up off of liquidity, a major pivot point, right? Because there's probably a lot of resting liquidity there. It's also 18,600, which 600 is a round number, which is a psychological level. So more than likely, this trend is going to continue to the downside. So if we didn't catch this impulse move up from the liquidity sweep off a major level, then we should be thinking that this trend is going to continue because this was such a vicious drop and so fast. Of course, needs a bounce back up to, regain its momentum to take it down another notch because there's so many liquidity and, retail buyers and everyone just, just blindly buying. Plus, the market just tends to go up because of, IRAs and, them NASDAQ has the 100 best companies. So the market does want to go up. But can it actually accumulate enough buyers to give us a bigger breakout than right here? So we're not in a trade yet. It just swept this downtrend. It's starting a new uptrend here. We're torn. Here, maybe we don't take a trade. Personally, I would probably take the short, even though it broke this brief downtrend. It's stalling around a major level. We had a massive cliff. I would risk the short here because I think it's a higher probability trade. Is it, 70-30? No, it's probably like 60-40 to work out. But the odds of this coming straight back up are much lower than it at least double bottoming right here and then possibly going up, right? Now, if we got a double bottom, we took this short, we got the double bottom, it held, then it broke above here once again, that would be probably a signal for high probability longs, right? But right now, we don't have too much going for us besides the trend of the day, which after consolidation and massive drops, it kind of shows that we have some bearishness here. We have CPI tomorrow. So, like, at this point, is it even worth taking the trade? Do you have the statistical advantage? It's up to you. It's at your discretion. But just thinking, plotting out what's bullish, what's bearish, is going to be beneficial to your trading, and just learning to think like, okay, this trade has a 50-50 chance of working out. We're bouncing off of a major level. Is it going to hold this support? If not, that's bearish. So that reinforces our belief that it's going to come back down here and double bottom, right? Because rarely will it just go straight up like this and hold a super sick uptrend, right? Statistically, bouncing off of a major level like it did, this is a high probability bounce, right? Because it's such a major level. But the probability of it going all the way back up there, that is much less likely than it having this bounce off the major level and then continuing the trend that it's already proven to do today, right? Does that make sense? Like a lick bounce, we don't know how big it's gonna be, so we would probably wait for our short entry, maybe take it off the trend line and have our stop, not too high. Maybe you would have it high. It's really up to you. I would probably have my stop somewhere in this zone, depending on the size I took. That's 40 points, right? So if I entered on the overshoot of the trend line or just right on the trend line, I'd probably risk 40, 50 points to make, 100. If I really truly believed that today was going to be a trend day. But it's the day before news, CPI news, so what are the odds that we actually have a big trend day? Probably not amazing. I mean, it could happen, but we don't know. So just like think about the probabilities. Like a massive trend day before news, I would lean towards unlikely. So it's at your discretion. But what I'm trying to like show you here is that just like add up the possibilities in your head, create a percentage chance for whatever plays you want to do, and then just go off of that, right? I mean, it can't break through this level, so this is starting to get bearish. So chances are it's going to go with the trend of the day, and it needs a double bottom before it comes back up. I think that has a higher probability than us longing right here and it just fucking mooning. I mean, it very well could, but the odds of it happening, just not so good, right? I mean, today was a terrible day for statistics and probabilities, just completely terrible. But we still made money. We still made, what, $13,000 today? I mean, right here, we have a daily uptrend line. It bounced off of it once, twice with a little bit of overshoot. I mean, this is just like a tough market to trade in. But the odds of this blasting up to here or here, I would say, are significantly less than this coming back down. Like, we just got another bearish sign. We have a bear hammer here, or a bull hammer. But we have this run up with a stall out right here at a major pivot point, right? This zone is just a major pivot point. It swept it. It's just a higher probability trade to bet that it's going to come back down than to enter longs here and run it up. right? A knife catch at a major pivot point, higher probability trade than it's straight continuing down forever. So just focusing on higher probability trades will just increase your likelihood for success, right? Now, even though this is a high probability short, even though it's kind of holding an uptrend, this is a tough trade. Would you even want to take this trade? Is it even worth the time to take this trade? Is it better off just to not to take the trade? I mean, maybe. You know what I mean? That's up to your discretion. But right here, right now, it's holding the uptrend, had an impulse move up. It was after a giant cliff dive, and it's bouncing off a major level, major zone. Because of this, I would suspect that this is just a lick sweep to come stop out the shorts, hit everyone's stop losses, and then continue a leg down. That is what I would get from this, right? Blindly taking a long here seems like a lower probability trade, even though it's holding the trend line. Now, if it broke through this zone into here, once again, and held this super short-term tight trend line, then maybe the odds would shift into a bullish trade. The point is, make that mental not Venn diagram, but like tally chart. Like what's bullish here, what's bearish. And then add that into your trade or into your strategy, and then take a trade off of it. Because if you could find more reasons for this to be bullish than bearish, then this might not be a terrible entry. Based on your strategy. I mean, on my strategy, it is a break of a downtrend. It is breaking through this pivot point slowly. Now the odds and the probabilities are leaning more into the bullish side. Would I still blindly take a long here? Maybe. Maybe I would. Maybe. Just a maybe. This is something that I would prefer to sit out of. So by focusing on higher probability trades, like taking a long from here to here, that might be a good little high probability scalp. But this is also a major zone. So is it worth taking it? Is it a high probability trade? You got to make these decisions for yourself, and look at the market and see what it does, and think about what you've experienced and what you see happening in the market over and over again. You need to like instill this into your head, write a Venn diagram or a chart about what's more bullish, what's more bearish. Ideally, the higher one is the one you're going to want to take, right? I mean, could this little scalp be good? I mean, it looks like it's bullish enough. It broke through major support levels. I would probably be short in here personally because I had a bear bias on the day. So I probably would have took a loss. But it would have been a high probability trade because even though it overshot it, and then it fucking just it diddled around at a pivot point and then it blew up, I still probably would have took this trade. I probably would have taken a loss, and I would have been okay with it because the next day when this same thing happens, it might just completely dump off a cliff. So just taking those high probability trades and just not caring about what the outcome is going to help make you tremendously more successful. Because sometimes, sure, it won't work out. Like today, it probably wouldn't have worked out. But on the days it does work out, we would have cleaned up what? Either 80 points ish, or held for a trend to drop even further, clean up 180 points. We would have taken what, maybe a 50-point stop loss, 50-point loss right here. I mean, we probably wouldn't even be in. We probably wouldn't even hit our stop loss. This is only 30 points. So if we entered somewhere around here, we could still be in this trade. And this could have just been manipulation before a massive cliff dive. It could be. But the point is, we don't know what the fuck's going to happen. We just don't know. But we can focus on the higher likelihood trades that also have way bigger reward than the risk. And that, I believe, is truly how you become a profitable trader. Just by fucking taking the trade, taking the L if you have to. It's okay. But take those high probability trades that, check all your boxes and have more bullish or have more bearish signs. And I think you'll be great along the way, long term. I think you'll be fantastic. Today, maybe not so good. Unless you took the short up here, which I was thinking about, but I would have been entered in right here, so it might have stopped me out. Today was just a hard day to trade, and hard days will come. And they're okay to take the loss. But statistically, this probably should have continued down and held a nice trend. Unfortunately, it didn't. But the next time we do this trade, let's say we take the loss and we walk away for the day because we don't want to overtrade, then the next time this happens, we could fucking 3, 4, 5x the loss we took today. So just focus on high probability trades, think in statistics, think in probabilities, what's more likely to happen, what's the market sentiment, put it all into factors, and just take the higher probability trades. And if they don't work out, it's okay. It's completely okay, because the next time they will work out, and then you'll get a much more bigger, much more reward than you risk, because you took a high probability trade. Yeah, that's it. Let me know what you guys think about this. Peace.